Hi, welcome to Main Street Macro. I'm Neela Richardson. It feels like change is everywhere these days. Change has become like that unwelcome house guest that's overstayed its welcome. But it's actually a good thing that we've all started getting used to change because there's more of it coming in 2022. In fact, one of the biggest places we're seeing change is in the inflation landscape. So, in this week's blog, we'll break down the three drivers of change in the inflation numbers this year. The first place we're seeing change is higher prices. Last week, the government released data showing that consumer prices increased 7% in December from a year earlier. And even if you strip out the most volatile elements of consumer prices, those being energy and food prices, we're still seeing inflation hit an increase of 5.5% from a year ago. So, taken together, we're seeing inflation numbers that we haven't seen in more than 3 decades. What that means for workers is that even though wages are rising, they're still not keeping up with inflation. So, real wages, those are wages minus inflation, is actually decreasing. It also, what it means for households is that most households spend a lot of their monthly budgets on places that are actually seeing a lot of increase. Those are food prices, energy prices, and housing. And so, what it means for low income households is that they are going to feel the impact of higher prices the hardest. The second place we're seeing change is in consumer spending. One of the reasons we're seeing such high inflation is because consumer demand has been remarkably and consistently high through the pandemic. The upshot here is that consumers have been spending. So, yeah, we're all a little bit to blame for the higher inflation numbers, but our high demand has come when supply has been low. So, even though we're all a little bit to blame for higher prices, we're also the reason why the economy is growing so fast and has been through the pandemic. Consumer spending is 70% of inflation. The hope is that consumer demand is stabilizing. The risk is that when inflation is high, consumer spending won't rev up the economy in the same way because the dollar doesn't go as far as it used to. The third place we're seeing and likely to see change this year is in interest rates. The Fed has a big tool to manage inflation, and that is interest rates. What they do is when the economy gets too hot, they start raising short term interest rates, which actually increases borrowing costs for both Wall Street and Main Street and curbs some of the demand. The Fed thinks by curbing that demand, it gives the supply side time to rev up its production and but as a consequence lowers price growth over time. Now this is tricky to do and it's tricky to pull off in even the best circumstances, but we do think that we'll see higher interest rates on Main Street in 2022 and perhaps into 2023. So, in all of this change, there is a winning combination for Main Street. If demand stabilizes, supply comes back to normal, and interest rates stay a little bit higher, but low enough to curb outpaced inflation, that's a good enough to keep Main Street moving forward. Thanks for watching the Main Street Macro. For more information on the week ahead, please go to adpri.org.